Hey guys, Andrew Houston here from Profit for Contractors. I'm in the Tradie Tip Think Tank, and I want to share with you guys something that before you do another quote that you've got to understand. Before you think about even lowering your prices, even a little bit to try and land a job, you've got to understand the concept and the impact of what can happen to your contracting business if you lower your prices, okay? It is an effect that can actually cause a lot of contractors, and I've seen a lot of contractors go under because of this. I'm also going to cover off with you guys the effects of increasing your margins and how you can do a ton less work and actually make more profit, okay, with a lot less risk. And then we're going to finish it up with a few areas in order for you to look at in your contracting business you guys can take away, take a look at, to hone in on how you can improve and increase your profit. So let's get right into this. So for the sake of today, we're going to use this contracting company. And this contracting company does $1 million in sales. Their average margin is 30%. So at the end of the year, they make $300K. Now, that's not a bad year for these guys, right? They're doing pretty good. But then the next year comes up, and they decide, you know what? We're going to lower our margins. Instead of 30%, we're going to go with 20%. And we're going to go with 20% because, you know, things are a little bit more challenging. There's maybe a little bit less work out there. You know, we want to keep our guys busy. A lot of different reasons, okay? So, and that happens a lot, right? Is we try to bring in enough business, keep everybody busy and everybody happy. And we think, hey, if I just lower my margins a bit, everything will be fine. It won't be that big of an impact. This is where a lot of contractors go wrong. So, this contracting company, throughout the year, you know, some of the quotes they've done have been below 20%, some have been above 20%, but on average, they've lowered their margins that following year, and they make, instead of 300K, they make 200K. So here's where it gets interesting. The difference between these two, I know you guys already have the answer, is 100K. 100K. So now we got to ask a really smart question. They are now quoting on average at 20%. So now the big question is, how much more work would they have to get at 20% for them to make up that 100K, for them to make that 300K? Are you ready for this? To make up that 100K, they would have to sell $500,000 in sales at 20% to make up for that 100K. They'd have to sell 50% more to make the same profit. Not more, the same profit. So anything below 50% increase in sales, they're actually losing profits. So you might ask, yeah, but wait a second, they just went from 30% to 20%. Okay? But the impact is massive. So let's look at this from a bigger picture. If they were able to go and make up that 100K by doing 500K more in sales, the impact on a contracting business is massive. Let's look at this from a time and money perspective. Time and money perspective. So what would have to happen? In the red, that's right, in the red, that means red's not good. Simple thing, but it adds up. Paperwork would go up exponentially, right? 50% more sales, you're going to get at least 50%, if not more paperwork that you need to do. Quoting, what's going to happen with quoting? Well, you know, I know, that you don't win 100% of the quotes. So for you to go land 50% more in sales, or for this contracting company to win 50% more sales, they're not just going to have to do more quotes, they're going to have to do exponentially more quotes. If their quote to win ratio, that means the amount of quotes that they do, the amount of jobs they win, okay, was 50%. So as an example, if they did 10 quotes, they would win 5 of them. If their conversion rate was 50%, their quote to win ratio was 50%, they would have to do more than double the quotes just to hope to land that 50% more in sales. And you know that's not what's going to happen, right? This is going to be massive chaos. Why massive chaos? Think about it. If they do land 50% more work, you guys know where this hurts. You know where the economy is. You know where the industry is at. We have a massive shortage of skilled trades. Can you imagine you having to get 50% more guys to do the work? That's huge. That's massive, okay? That's going to be a major challenge for you. That doesn't include the amount of callbacks. Because now you got to manage more quotes, you got to manage way more team members, you got to manage way more paperwork. What's going to happen to your business? Your efficiency, your effectiveness, the amount of noise and chaos, the amount of problems are going to go through the roof. And what tends to follow that is your callbacks go through the roof. Because chaos breeds chaos, right? Next. Because you're lowering your prices, what tends to happen is you end up landing more and more clients because of price instead of value. And those guys I call class Ds, which are like deadbeats. Like those are typically the guys, I'm sure you can relate to, where they don't pay you, right? They're difficult to work with, bad communication skills, right? They expect everything for nothing. And even after you've done a great job, them giving you repeat business is only going to be based upon you giving the lowest price again, right? Not value. So what happens when you get more paperwork, more quoting, more team members required, more callbacks, more Class D clients, right? Think about this. Your risk factor goes through the roof. And then there's a domino effect. Why? Your profits end up tanking. Because if you had a little tiny crack in your foundation in your business, it's now opening up like a massive crevice because of all this extra workload, all these additional moving parts, all these extra things that you have to do in hope, okay, in hope that you're able to get 50% more work. And when you end up having your cash flow tank, you're a major problem. Now, why is your cash flow going to tank? Your cash flow is going to tank because it's going to take that much more effort with that much less profits to manage the business. And what tends to happen when we increase our workload by 50%, you know what it's like, right? You got to pay the suppliers, you got to pay your guys, you got to pay the tax man, you got to love the government, right? You got to pay everybody before you pay yourself. And so if you even had any sort of weakness in cash flow, this here tends to put the companies out of business because the amount of cash that you need to float to manage this much work is through the roof. And all we did was we just decreased our margins from 30% down to 20%. So, if you're thinking about decreasing your margins on any jobs, stop and think about it, okay? Now I'm going to show you the flip side. I'm going to show you what can happen if you increase your margins, okay? Now, you might be looking at these margins going, man, those look really high, or those look okay. It doesn't matter. Mathematically, it's the same impact, okay? As far as the amount of you increasing your margin or decreasing your margin, okay? As a percentage, it's going to be the exact same thing for everybody, okay? So here we go. Let's take a look at this guy. I love this method, which is increasing your margins, okay? So let's take that company, that same company that was doing $1 million in sales, right? Just a bit of a refresher, they're at 30 points. So what happens? They end up making $300K in profit. Good, right? Now that same company decides that, you know what, instead of 30 points, they're going to increase the efficiency of their jobs. They're going to make sure that the guys are more effective. They're going to filter fast to make sure they don't have Class D clients, and they're going to focus on only Class A clients, right? They're going to make sure that they got a process for how to pre-start and run and finish a job. They're going to put systems in place to ensure that they're quoting profitably every time, and so many other things. They're able to then increase their margins by 40%. This isn't just increasing their prices. This is increasing their margins. Maybe they only had to increase their prices by 5%, and they made up the additional 5% by all those other efficiencies, all those other areas that we worked on in increasing your margins. Okay, so let's take a look. they would be able to, this is amazing, they would be able to do $750K in work, and they would make the exact same profit. What does that mean? That means that they could do $250K less in work before they lose any profit. That means anything between 0 and 250K, they're actually making more profit. So instead of $1 million in sales, they could do $750,000 in sales. That means 25% less work, 25% less vehicles, 25% less guys, manpower, probably 50% less quoting, back to that conversion rate that we talked about. So way less quoting, way less paperwork, way less cash flow for them to try and manage all that material and extra effort, okay, on $250,000, and they're still going to be more profitable. And when you think about it, you know, could you increase your margins and your efficiency by 5, 6, 7%? Could you improve your profits by 1% every single month in a year? I don't know, maybe not every single month, but even, 10 months out of the year? Of course you can. So let's get more into depth around like how exactly can you do that? And where do you start? Let's do this. So what we want to look at here is what I call the profit funnel. And the profit funnel is a really good tool for you to know where to start looking first. There is a method to the madness. There is an order in which you have to look at your profits and find the opportunities for profits and plug the leaks in profits. The very first place that we got to look at is this guy right here. Are you profitable? How do you find that out? Really easy, really simple. Pick up the phone, send an email to your bookkeeper or your admin person that does the financials and get a profit and loss statement generated, okay? You want to start with the last 12 months to see whether or not over the last 12 months you were profitable. You need to know this, okay? You need to know this so that you are aware of what your margin is based upon your total sales. So that you can understand exactly, specific to your contracting company, where you're at. Because once you know where you're at, then you can start setting targets and goals for getting to where you want to go. That now that we know, picture you've sent the email, you've gotten it back, you looked at the bottom, and if you have even a slightly good bookkeeper or accountant, get them to explain it to you. Get them to share with you, why that number is the way that it is around your expenses, your fixed expenses, your variable expenses. But number one, you got to know whether or not you're profitable or not, and to what degree. Next thing that you want to do is you want to make sure that you are pricing profitably. Pricing profitably, okay? And that just doesn't include your material and your labor. You've got to look at something, called your break-even margin. You got to make sure that you know what percentage of expenses against sales is, the cost of keeping the lights on, paying the insurance, paying the salaries, and all those things that whether you get a sale or not, that, you've got to pay those expenses. So you got to make sure you're pricing profitably. Because if you're not 100% sure you're pricing profitably, if you don't have a system for this, and you price a job and you don't price it profitably, you've already lost the game before you started. Next is we want to make sure that we have a profitable team. Okay? And some of the things you want to look at regarding having a profitable team is you want to do something that's called back costing. You want to take a look back at the jobs that have finished and you want to go, hey, if this is how we quoted the jobs, if this is how we did the jobs, what is the difference between the two? What's the difference in material? What's the difference in labor? Are we on the same page from what we quoted to how the guys did the job? Okay? That's called back costing. Next thing you want to look at, okay, is do you do profitable types of work? Maybe, what are you talking about, profitable types of work? Look, most contractors don't just do one thing, okay? They might do service work, they might do commercial work, they might do residential work. You need to break down the different segments in your contracting business to know whether or not you are actually doing the type of work that's making you money. Too many times what will happen with contracting companies is they will have profitable work paying for the non-profitable work. And there's a couple of key areas that cause non-profitable work: that you didn't price the job properly, that the guys are not capable of doing the job properly, even if it was quoted properly, that you're doing types of work that you're not really expert at, that you don't have the right systems for. And the last one, okay, profitable clients. Okay, this is huge, right? You've had clients that have, not paid you. You've had clients that have been difficult to work for. You've had clients that, really, like I said in the beginning, all they do is buy from you because you're the lowest price. You've got to make sure you're only working with Class A awesome clients or Class B basic clients that are moving up to Class A, that really understand the value of your time, of your team, of your company, of the product and service that you offer. So, let's take a look. Bit of a recap. Increasing your prices, okay? If this company increased their margins by 40% and increased their prices a bit, efficiencies, not just the pricing, but other aspects of the business, they could do $250,000 less work and still be profitable, the same level of profitability. Can you imagine that, right? Like, can you imagine that, if they did, $800,000 in sales versus $1 million, they're going to be actually more profitable, and yet they're not going to have to do $200,000 less in work. I mean, that's huge, right? And we haven't even, incorporated all the additional expenses from management, of managing those people and the team and putting in more systems to manage all that extra workload. So look, before you go to reduce any pricing on your jobs, okay, seriously consider the impact that it has on your business. Look, I get it. Sometimes you got to price lower to get jobs. I get it, okay? I had to do the same thing. But if you don't look at it in a bigger picture, if you don't track your margin along the way, you could end up like this company here, okay? Having to get a ton more work and still not making more profit. So, I'd love to hear your comments below. I'd love to hear what your thoughts are. And that is today's trading tip. Take it, use it, apply it, one small step at a time. First of all, understand your margins. Then from that point, follow the profit funnel in this order to put things into action and get the quickest results as fast and as easy as possible. See you guys on the flip side. Love to hear your comments down below. Cheers.